Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a fascinating story that's been making waves in the financial sector. It appears that Wall Street is bracing for a significant shift in the Federal Reserve's $6.6 trillion balance sheet, which could have major implications for the economy and your investments. This development comes as Bitcoin's price has surged nearly 10% to surpass 101,000, recovering from a recent flash crash. According to reports, the Federal Reserve is expected to halt its quantitative tightening program, which has been reducing its balance sheet from around $9 trillion to $6.6 trillion since 2022. This move could lead to an increase in liquidity and stimulate the appreciation of risk assets like Bitcoin. Analysts from J.P. Morgan and Bank of America are predicting that the Fed will stop contracting its balance sheet this month, which could have significant implications for investors. Some experts, like Arthur Hayes, co-founder of crypto derivatives pioneer BitMEX, believe that this shift could trigger an increase in money printing starting next year, potentially driving asset appreciation and even pushing Bitcoin's price to $1 million. However, it's essential to note that these predictions are speculative and may not come to fruition. As we delve into this story, it's crucial to consider the potential risks and benefits associated with the Federal Reserve's actions. On one hand, an increase in liquidity could stimulate economic growth and boost asset prices. On the other hand, excessive money printing could lead to inflation and erode the purchasing power of the dollar. We'll be keeping a close eye on these developments and providing you with balanced analysis and insights to help you navigate the complex world of finance. Whether you're a seasoned investor or just starting out, it's essential to stay informed and adapt to changing market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today, we're looking at Keurig Dr. Pepper, a company that's been making headlines with its recent merger announcement and third-quarter earnings report. Let's start with the basics. Keurig Dr. Pepper reported a 10.7% increase in revenue to $4.31 billion, beating analyst expectations by nearly 4%. Adjusted earnings also rose 5.9% to $0.54 per diluted share, which was in line with analyst estimates. The company raised its full-year revenue growth target from mid-single-digit to high single-digit percentages. Now, you might be wondering what drove this strong performance. Well, it's worth noting that the company's coffee segment struggled with just 1.5% revenue growth due to inflation-based price increases driving customers away. However, other segments, such as energy drinks, performed well, which helped offset the weakness in coffee sales. The big news, of course, is Keurig Dr. Pepper's pending acquisition of Dutch coffee giant JDE Peet's for $18 billion. The deal is now supported by $7 billion in funding from KKR and Apollo subsidiaries. Once completed, the transaction will create two new companies, one focused on coffee and the other on everything else in the Peet's plus Keurig portfolio. Investors seem to be cautiously optimistic about the merger, with Keurig Dr. Pepper's stock jumping 10.5% earlier today before settling down to a 6.9% gain by noon ET. However, it's worth noting that the combined market value of Keurig Dr. Pepper and JDE Peet's has fallen $5.6 billion since the merger announcement. As always, we want to provide you with a balanced view of the situation. While some investors may be concerned about the coffee industry's economic pressures and the potential risks associated with the merger, others see this deal as an opportunity for Keurig Dr. Pepper to expand its presence in the global coffee market. Ultimately, it's up to each individual investor to weigh the pros and cons and make their own informed decision. We'll continue to monitor the situation and provide you with updates as more information becomes available. Welcome back to the Riskwiser Zone, where we cut through the noise and bring you the most important stories in the world of finance. Today, we're going to talk about a potential buyout that's got everyone buzzing. the proposed takeover of Janus Henderson Group by activist investor Trian Fund Management. Now, I know some of you might be thinking, Janus who? But trust me, this is a big deal. Janus Henderson is a major player in the financial services industry, with over 2,000 employees and a presence on the New York Stock Exchange. And Trian's offer of 46 per share is nothing to sneeze at. It represents a significant premium to the company's current stock price. So, what's behind this move? Well, according to Trian's founder, Nelson Peltz, the proposed transaction would de-risk an investment that's highly sensitive to capital market and geopolitical dynamics. In other words, by taking Janus Henderson private, Trian hopes to shield the company from the wild swings of the stock market and the unpredictable world of global politics. But is this a good deal for shareholders? That's the million-dollar question. On the one hand, the offer price is certainly attractive. It's higher than the stock has traded in recent months, and it gives investors a chance to cash out at a nice profit. On the other hand, some might argue that Janus Henderson is undervalued and that Trian is trying to take advantage of the company's current situation. As always, we want to hear from you, our listeners. Do you think this is a good deal for Janus Henderson shareholders? Should they accept Trian's offer and cash out, or do they have a better chance of making money by holding on to their shares? Now, I know some of you might be thinking, but Lewis, what about the broader implications of this deal? Well, that's a great question. If Trian is successful in its bid for Janus Henderson, it could have significant consequences for the financial services industry as a whole. It could lead to more consolidation, more mergers and acquisitions, and potentially even more activism from investors like Trian. So, what does it all mean? Well, as always, we'll be keeping a close eye on this story and bringing you updates as more information becomes available. In the meantime, remember that investing is all about managing risk, and sometimes that means taking a step back and assessing the situation before making a move. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.